Big news from the federal government last month that could change the way Canadians buy homes. If you've been keeping up with the real estate market, you've probably noticed it's been cooling down recently. But just when things seem to be stabilizing, the government stepped in again with two major mortgage changes that could reshape the housing market. Hey everyone, I'm Kashnaz and welcome back to Property Ladder. In this video, we'll be breaking down the new mortgage changes and exploring how they impact the market. You don't want to miss this, so let's dive in. Let's start with the biggest change. The government has raised the CMHC insured mortgage limit from $1 million to $1.5 million. This means buyers can now put down less than 20% on homes valued up to $1.5 million. Before this change, if you were buying a home priced at $1 million or higher, you were required to put down at least 20% of the purchase price, which made it harder for many buyers. Here's a quick example. Before the change, if you wanted to buy $1 million home, you needed to come up with a minimum down payment of $200,000 or 20%. Now with the new limit, the minimum down payment drops to $75,000. That's a huge difference. While this doesn't guarantee that you'll qualify for a larger mortgage, it certainly makes that initial financial commitment more manageable for buyers who previously struggled to save for the minimum 20% down payment. Now, while this is beneficial in terms of the upfront cost, it's essential to keep in mind some important downsides to this change. First off, when you go with a down payment of less than 20%, you will need to pay for mortgage insurance. This insurance is designed to protect the lender, not you as the borrower, and further adds an extra cost to your monthly mortgage payments. So while it may be easier to buy a home upfront, it can ultimately increase your overall monthly expenses. Additionally, a smaller down payment means you will have less equity in your home right from the start. This reduced equity can pose a higher risk, especially in a fluctuating market where property values might decrease. And lastly, the allure of a lower down payment might tempt buyers to stretch their budgets and pursue more expensive homes than they can truly afford. Just make sure that you consider all of these factors before utilizing the benefits of this new change. Okay, next let's talk about the extended 30-year amortization period. First-time homebuyers and those purchasing newly built homes with a down payment of less than 20% will now have the option to stretch their mortgage payments over 30 years instead of the standard 25 years. This change is intended to reduce monthly payments and ease the burden on buyers entering the market. To give you an idea of the impact, let's compare monthly payments for a $600,000 home. At a current interest rate of approximately 5%, if you opt for a 25-year term, your monthly payments would be around $3,700. In contrast, with a 30-year term, your monthly payments would drop to about $3,200. That's a difference of approximately $500 each month, making home ownership more affordable for many buyers. Now, we've calculated the difference in monthly payments, but it's equally, if not more important, to look at the total interest you'll end up paying over the life of the loan. For the 25-year mortgage, you would pay approximately $270,000 in total interest. However, with a 30-year term, the total interest paid would rise to about $320,000. So while you're saving on monthly payments, you do end up paying approximately $50,000 more in interest over the life of the mortgage. While this extended amortization does provide first-time homebuyers with breathing room in their monthly budgets, it's crucial to weigh this against the long-term cost of the mortgage and how this impacts your financial capacity in the long run. So will these changes actually help the housing market? Well, there are pros and cons. On the one hand, it will make it easier for some buyers to enter the market with access to cheaper monthly payments and smaller down payment requirements. This could revitalize segments like Toronto condos where demand has slowed. On the other hand, let's be real, this isn't great for inflation. The Bank of Canada has been working hard to control inflation and cut rates, and now we have this policy which will likely stir up more demand and add pressure to an already inflated economy. There's also a flip side to the idea of affordability. While these changes at first glance may seem to make homes more accessible, in the long term, this could lead to a cycle where home prices keep climbing, making them even less affordable. Instead of managing affordability, these policies seem to be creating more demand without addressing the real pressing issue, which is the lack of housing supply. It's also impossible to ignore the political timing of these changes. With an election on the horizon, it's clear this move is designed to generate buzz and attract potential voters. At the end of the day, these changes are bound to shake up the market. How exactly? We're gonna have to wait and see. What do you guys think? Are they a win for buyers, or are they just adding more fuel to the fire? Let me know your thoughts in the comments below. Thanks again for watching Property Ladder, and don't forget to like, subscribe, and hit the notification bell for more real estate updates. See you in the next one.